Okay, so we're going to start. Today's webinar, we're going to talk about the two key events for the week and perhaps the month, the ECB decision and the non-farm payrolls with euro-dollar. Okay, just a quick note about myself. My name is Yohay Elam. I used to be a retail trader and a computer programmer. I founded Forex Crunch back in 2008. The focus of the website is about fundamental analysis. I also touch technical analysis, but it's mostly about what moves markets, not only entry points and exit points. Here's what we're going to talk about. Current state of euro-dollar. As we know, it's just under 125, but we'll look at other levels. We'll look at the economic background for the ECB decision, the recent ECB political storm that happened yesterday and is going to have a big impact on the decision tomorrow, the various scenarios or what to listen to when Draghi says. Then we're going to shift to the United States, talk about the state of the Fed after it finished QE last month, and non-farm payrolls preview. We have almost all the hints already out there, and then Q&A session. All in all, the focus is on the ECB decision. It's because I think it's more interesting, has more impact, more moving parts. Non-farm payrolls has been relatively steady, but okay, let's begin. So this is a recent chart of euro-dollar that I took this morning, a daily chart. Since May, as we all know, it has been falling. The lines to watch from top to bottom are 130, 127.70, 126.20, 125.70, which has been the top yesterday, I think. 125, 124.40, which has been the bottom. And beyond that, we have ancient levels 123.60, 22.50, 21.50, and 20.40, which was the low when Draghi said he'll do everything it takes. And what brought us here? Well, basically, it's monetary policy divergence. You can see on the left Mario Draghi looking at one direction and Janet Yellen looking to the other direction. Or in more words, the ECB is said to keep rates low for at least 2 more years, at least until the end of 2016, and even add more measures, like perhaps QE. We'll talk about it. The Fed just ended QE, it ended its bond buying program, ended printing dollars, and the rate hike is getting closer. Nobody knows exactly when, but it's getting closer than the ECB, that's for sure. And markets continue responding in the last few months. It's never a straight line in Forex trading. It's always a bit of ups, a bit of downs, but the general trend is quite clear, down. So what's going on in the Eurozone from here in Barcelona? Talk about the bigger countries, Germany and France. Low inflation, which is, of course, the key. The ECB has only one mandate, keeping inflation under control. Russia, which has an impact, of course. And what the ECB has done so far is did quite a lot, but the tools are working slowly. So let's talk about Germany, Europe's largest economy, not only in the Eurozone, but in Europe in general. In the second quarter of Q2, it contracted by 0.2%. Business confidence continues falling. The IFO figure, the ZU figure, both are falling and falling and falling month after month since the beginning of the year. Specifically, ZU is at negative, it's minus 3.6. And this reflects pessimism among the German business community. It's important to note that German PMIs, Purchasing Managers Indicators, which are considered forward-looking indices, did not point to that recession in Q2. There's a good chance that Germany contracted also in Q3, making it an official recession. We'll know that in 1 week's time, on November 14th. The German government recently cut its forecast to 1.2 growth in 2014. And just yesterday, the European Union, the European Commission, cut the German GDP and inflation forecasts. So all in all, the picture is worsening. Not all is bad, and to be fair. Unemployment surprisingly dropped in September by 22,000 people. And that's good news, less unemployed in Germany. PMIs, as aforementioned, you should take them with a grain of salt, but they are looking better. And the German government wants a balanced budget, and this is euro positive. But all in all, its picture is not going in the right direction as far as I see it. France, the second core country, second largest economy. They refused to adjust to the European, to Eurozone guidelines. They have flat growth for 3 quarters, if I'm not mistaken. A fear of recession also there. Rising jobless claims. Contrary to Germany, unemployment is rising. And unpopular politicians. The French president, François Hollande, has the lowest ever approval rating, and his opponent is Nicolas Sarkozy, which used to be president, and he's making a comeback, and that's not a good choice either. So picture isn't that bright for France either. And inflation, that's the key mandate of the ECB, and it's extremely low. It has been extremely low also in October. It's at 0.4% in the headline CPI, and the lowest so far this year is 0.3, but it'll probably fall again because we have falling oil prices in October and in November. Core CPI is at 0.7, so it's not only oil prices, it's also core figures. German inflation is at 0.7%. Spain is experiencing outright deflation. The European Union forecasts 0.5% inflation in 2014 and 0.8 in 2015. No matter how you look at inflation numbers, the ECB has a target of 2%, and it's not getting any closer. So that's bad. Okay, regarding energy prices, a few more figures. WTI crude oil is around $77 a barrel, Brent around 82, what I looked earlier today. All in all, it's about a drop of a quarter since June in values. In addition, there's glut from Russian sanctions because Russia doesn't import food. We'll talk about that later as well. And banks have been worried about stress test, and they haven't been able to push inflation higher by lending more money. Russia. Okay, the crisis is still not over. They're still fighting in the east of Ukraine. Winter is coming, and that's important because European Union, especially Germany, relies on Russian gas. There's always the danger that the Russians will just shut it down. There is significant trade with Russia, and all the sanctions that the European Union has against Russia and the counter sanctions are bad for both sides. They weigh on inflation. The positive around Russia, the bad things are that this also contributes to falling business confidence in Germany, and it brings worries from the shivers from the Cold War. But some things are changing in Russia. The Russian ruble is under pressure. It's falling and falling against the dollar and against the euro. And this makes food imports more important, more expensive for Russia. And oil prices in US dollars are falling, and Russia exports oil. So I think at the moment we didn't hear about any new sanctions for quite a few months. So it's not getting any worse, at least. It's not getting better, but it's not getting any worse. And fourth impact, ECB did introduce a lot of tools. TLTRO is targeted loans. The first installment was had a poor reception. Basically, nobody wanted Draghi's money. Only 82.6 billion euros were lent out. These loans are meant for the real economy, so the banks get them only if they lend it to real business and not invested in bonds or something like that. Hopefully, the next installment of the TLTRO is in December, and hopefully it'll be better. ABS, the asset-backed securities that the ECB introduced just in September, it has already begun. But so far it's moving slowly. Only 5 billion of ABS has been bought. And of course there's pressure to do more. We'll talk about it. So, more about the economic background for the ECB decision. As I said before, the ECB, the European Central Bank, has a target of 2% or a bit below of headline inflation, CPI, not core inflation, like the Fed or like in Japan. And this target is being missed month after month. So 0.4, 0.3 is not a bit below, it's far below. It means that the debt burden is heavier, you can't inflate your way out of it. And of course, there is the D word, deflation. What's wrong in deflation? What's wrong when prices fall? Well, you can think that if you pay less for stuff, you have more money in your pocket, and it's a good thing. But if it becomes chronic, and that's the danger here, prices fall, and you expect them to fall even further, so you don't buy, and then factories produce less, and then people lose their jobs because there's no work in the factory, and then there's less consumption, and this is a vicious cycle, and the world already experienced it in the past. So we had the Great Depression in the 30s in the United States. There was this kind of vicious cycle, and we had that recently in Japan, which wasn't that depressing, but Japan is suffering from deflation for around 20 years after the boom and bust of the real estate sector. And we've seen only in recent years the Bank of Japan do a lot of stuff, especially last week. It's a second round of money printing, yen printing, to try to get out of this mentality, get prices moving, to get the economy moving as well, because growth and inflation go hand in hand. The key is to have controlled inflation and steady growth and not have a boom and a bust. So a bit of recent history about European inflation. The big deterioration began in October 2013, that's 1 year ago, with the fall of headline inflation to 0.7%. So the ECB reacted immediately back in November that year with the cut to 0.25%, but it had no choice but to continue cutting in June to 0.15 with the first historic negative deposit rate, and then in September to 0.05%, which is basically zero. In addition, there is a negative deposit rate of 0.20%. That means that banks are basically punished if they park their money with the ECB. Recent bottom is 0.3%, and core inflation is at 0.7, which is also the bottom level. We did have impact on the exchange rate from all the moves by the ECB. Euro dollar is more than 10% weaker since May, when it just touched 140. It's the lowest since November 2012, but probably not low enough to push inflation lower. I would assume now, with current inflation, that the ECB would rather see a euro-dollar exchange rate of 120 or even lower. It's currently at 124.60 something, just under 125, and it did fall a lot, but probably not enough because inflation isn't falling. So far, the ECB did have this kind of approach of denial of inflation. I don't want to hear you. But they did warn that if lowflation, as some people call it, low inflation stays for too long, it is dangerous. So eventually they did raise the rhetoric and explicitly connected monetary policy to the exchange rate, and did the monetary blitz, the rate cuts, negative deposit rate included, and recently the TLTRO, ABS, all that kind of stuff to enlarge the balance sheet and to trigger more growth. So far, can't really see the success, only maybe green shoots. Back in August, Draghi even went further and explained the correlation or talked specifically about euro-dollar. He said the fundamentals of a lower euro-dollar are in place. Central banks usually avoid talking so explicitly, especially the ECB, about the exchange rate, but this was extreme. And since that statement 3 months ago, euro-dollar, of course, fell further. Well, the measures that the ECB took in June and September, flows that have changed, and monetary policy divergence are responsible for the change. One note about flows. After Draghi's Everything It Takes speech back in 2012, investors got more confident and they invested back in European bonds. So bond yields went down, but they're already very low. You see, for example, Spanish bond yields are lower than American bond yields. Is Spain a safer investment than the United States? I don't think so. But so money began flowing out a bit, or at least stopped coming in. And this also weighs on the euro. Just a recap of September: main lending rate 0.05, deposit rate 0.20. And another thing, Draghi did state explicitly that rates have reached their lower bound. That means we don't expect any more rate cuts, but we don't expect rates to rise either. So what else did the ECB do in September? It announced the ABS program, asset-backed securities, basically creating euros and taking assets off the balance sheet of banks, allowing them to lend more money to the real economy. When asked about the size of this program, Draghi said that he wants the ECB's balance sheet to reach around 1 trillion. He wanted that the size of the ECB balance sheet to reach levels of 2012, and that's around 1 trillion euros more than it is today. But this caused a political storm, and that's the second topic, and it all broke out yesterday. Germany is more conservative about inflation. It had this bad experience in the 20s with hyperinflation, and it wants to have low inflation at any cost. It doesn't seem too fearful of deflation. In the past, 2 German members quit the ECB for the measures it did then, which were not as bold as Draghi did. In the meantime, they have a more flexible president of the Bundesbank, the German central bank, Jens Weidmann. But also for him, it has become perhaps too much, all this monetary financing. It means printing euros and lending it, basically buying bonds is basically lending money to Eurozone governments. So that's where it all began. According to some rumors, reports, Jens Weidmann, the president of the Bundesbank, and Draghi are not talking for months. Okay, that may sound a bit childish, but other things are perhaps more important. The Jackson Hole speech back in late August was not communicated not to Weidmann and not to the other members of the ECB. In this speech, he tied lower inflation expectations to more monetary action. And also the hint about this 1 trillion euros was not coordinated. Germans, of course, oppose QE, quantitative easing. They oppose creating fresh euros and buying bonds. And yesterday, it all broke out. It was a big mess. Reuters had this exclusive, this bombshell about that the ECB members, that they're about to challenge Draghi's management style, that he's not consulting, he's not listening. He has 3 mobile phones on the table, and he's all the time looking at them, and he's leaving the room, and he doesn't consult anybody. Some of it sounds a bit like gossip, but some is sounds serious, in my opinion. Anyway, they sort of were longing for Trichet's management style. Jean-Claude Trichet, the former head of the ECB, he was much tougher about inflation, and I think he made grave mistakes. And I think the real message is not Draghi's style, but rather the Germans want Draghi to cooperate with their policy, and Draghi is not cooperating. He's doing a lot and not always consulting them or doing what they want, going too far. In any case, we saw yesterday that this move, this news that came out of Reuters, it sent the euro up because markets thought that if there's a lot of opposition to Draghi within the ECB, especially within Germany, the biggest country, it means no more stimulus. It means that Draghi's hands are tied, and even more, perhaps Draghi would quit after 3 years and become the president of Italy, which is more of a ceremonial role, but there were rumors for quite some time that he might take over as the current president of Italy is retiring. So the euro rose, and the question is, should it rise even more because there's not going to be any more stimulus? I don't think so. As far as I see it, what happened yesterday was like a spin made for the German public. The German politicians, German central banks want to be seen as acting, as doing something, as saying something, as putting up a fight. But in fact, the ECB is failing on its inflation mission, inflation mandate, and also Germany is on the verge of recession. So I believe that Draghi is going to be determined and is going to push through. Basically, ECB has a target of 2% inflation, and it's at 0.3, 0.4% for a long time. That's a failure, so it has to do more to fulfill its mandate. So what could the ECB do now? Well, nothing, because rates have already reached their lower bound. But Draghi is very powerful with words, and I believe he will use his mouth. in various ways. So, of course, the hottest topic is details of the balance sheet expansion. ABS is a bit limited, but there are other tools. As view on inflation, open door to QE, view on stress tests, which were released about 2 weeks ago, and of course the exchange rate, which we all focus on. Details of the balance sheet, a bit more of a timetable, more types of instruments. We know about asset-backed securities, but we want to know about buying corporate bonds, which was one option. I don't think it'll happen, but that's an option. Perhaps more technical details about how they'll do it, but probably no overall size because of the German opposition, and because they have a variety of tools and they don't think they want to commit to using one specific tool. So I'm not sure we'll get sort of numbers, but if we do get a number, and if it's a big number, if it's a repeat of the 1 trillion euro stance, it's of course euro negative. If it's a small number, it's euro positive. I think there's a better chance we'll hear only descriptions in words. So if there's a firm, unequivocal commitment to do whatever it takes and to print as much money as it takes to battle the danger of deflation, it's of course euro negative. If there's a more cautious wait and see approach, if Draghi is seen as sort of moving under German pressure, it'll be euro positive, of course. And if you're on inflation, well, last time that I had this webinar a month ago, I had on one hand, on the other hand, some things are positive, some things are negative. As far as I see it now, everything's negative. Inflation is at rock bottom levels. Lower euro, what he was missing, sorry, hasn't helped yet. Energy prices continued falling and are said to push inflation even lower. Even if you take energy prices and food prices out of the picture, core inflation is low. And the EU forecast for 0.8 inflation in 2015 means that the ECB will have to do more to push it to 2% or a bit below. That means at least double than 0.8. I think that Draghi will probably continue denying the danger of deflation. We'll see it moving up. Okay, also the European Union, the European Commission sees it as positive inflation and not negative. But he is likely to repeat the commitment to do everything to reach the ECB mandate. This could be negative for the euro. If he does warn about deflation, which I think is unlikely, the euro will, of course, fall even further. We had the stress tests a week and a half ago. They showed only a very small number of banks failed, and the missing capital shortfall is a bit small. Of course, they didn't take the scenario of deflation into account. I think that Draghi will show optimism about it. There are also a few positive signs. Private lending is still contracting, but a bit slower. So he could say that there's progress here. But if Draghi is worried, it could be, of course, negative for the euro. But I think this specific topic is not going to rock the boat too much. Door open to QE, this is the most sensitive figure, especially after this bombshell, all the gossip. I think Draghi in general would prefer to avoid QE due to German opposition, but he might need to use it or at least continue leaving the door open for euro printing because it has an impact on the exchange rate, which is of course needed. This is a key point of contention in the press conference. I think he'll be asked lots of questions about his relations with Jens Weidmann and the German opposition. And if he consults other members, I think he's going to have a really tough time. In the past, we've seen Draghi sometimes release important hints during the press conference, during the Q&A session, sorry. That means he might prepare a surprise for that moment. So it's worth following the press conference, the full hour of the press conference, not only the opening statement for moves in euro dollar. More about door open to QE. Yeah, as I said, he is likely to leave the door open. Of course, this helps put pressure on the euro. If he closes the door on QE, that it'll show that he's surrendering to German pressure, and the euro is likely to go up. And last thing regarding the ECB, the exchange rate, all important. Well, euro dollar did fall a lot. The euro is weaker also against the pound and also against other currencies, including the Chinese yuan, an important trade partner. Mario Draghi is probably smiling inside on this progress, but he needs more. I guess euro dollar under 120. But the ECB officially doesn't have a target, so he'll be tiptoeing on this topic a bit gently. I don't think he'll say anything very, very explicit because euro dollar is still lower. If he will hint that it's not enough, he could use this opportunity and hit the euro when it's down. This would be, of course, euro negative. A weaker level of the euro is necessary to lift inflation, to boost exports. The lower exchange rate makes exports more attractive, and to avoid outright QE, avoiding a political battle with the Germans. As aforementioned, euro dollar under 120 will probably be satisfactory, but we're not that close. We're seeing some support there. No. All in all, let's do a roundup of the ECB. All in all, no new measures, more balance sheet expansion details, but probably without an outright number. Commitment to fight low inflation, but deny there's a chance of deflation. Some optimism on the banks, and open a door to QE, a sensitive political point, which will be probably talked about quite a lot in the press conference. All in all, Draghi's objective, I think, is to keep the pressure on euro dollar. Let's see if he succeeds. He did it quite successfully in the past when he wanted to. Okay, now to the other side of the Atlantic. Just a second. So, Janet Yellen, here she's smiling. In the October meeting, QE3 finally ended after the doubts that were cast by James Bullard. So it's gone, no hints about QE4. The Fed still maintains the size of its balance sheet at around 4.5 trillion euros, which is, by the way, more or less the size of the German economy. But it's not expanding it. So QE3 is over. What was surprising in the decision was that it was bullish on jobs. Yellen and her friends said there are solid job gains, diminishing underutilization, all these kind of hawkish words that you don't usually see from the Fed. They weren't also too worried about inflation, even though it's better than in Europe. Core PC price index is 1.5%, but it's not steaming hot. There's still a considerable time until a rate hike. I think that they'll change this phrase only when they have a press conference, maybe in December. And for a change, instead of two hawkish dissenters, there was one dovish dissenter. So when the doves cry, as Prince said, that means it's a hawkish decision. And the dollar reacted very positively. It was just 1 week ago. In addition, recent US data has been all in all positive. Let's start with the positive and then mention a few negatives. Q3 growth was 3.5% annualized. And that came out better than expectations and is quite healthy. Jobless claims are the lowest since the year 2000. Strong manufacturing PMI. Okay, now we had just now the not so impressive non-manufacturing PMI, but it still shows solid growth. We have strong consumer confidence, which implies, in theory at least, more spending in the future. And we are beginning to see initial signs of wage hikes. This has been also a problematic figure. We have more jobs, but no rise in wages. Salaries are still low. But we've seen the employment cost index, which was released with the GDP, that did rise more than expected. And the ADP quarterly report, not the jobs report, but sort of market health report. And they show that wages are rising, especially, of course, if you change jobs. If you stay at the same job, rate hikes usually happen only around the turn of the year in January. So I believe wage hikes are around the corner in the United States, and there are very, very small signs of that, but still nothing is significant. On the downside, we had disappointing retail sales in September, disappointing durable goods orders, and housing numbers are a bit mixed. But all in all, the situation is okay, especially on inflation, and is even really good on jobs, and that's what the Fed cares about. Okay, so now let's talk about tomorrow's non-farm payrolls. Let's look back at what happened last time. We had an excellent headline number, 248,000 jobs gained in the United States in September. We had big positive revisions. They erased the doubt that the U.S. economy was slowing down because August number was terrible, so that was upgraded, and now everything seems okay. Unemployment rate fell below 6% to 5.9%. That's excellent news, especially for politicians. Well, we didn't really help Obama, but anyway, it came on the back of low participation rate, and the annual wage growth stayed at 2%. But if we look at the most important thing, at the momentum, job gains, they continue solid growth, the best since the 90s. So what are we expecting now? More of the same in terms of job gains, 225,000. Of course, expectations changed just a bit after the ISM non-manufacturing PMI and the jobless claims that we have tomorrow. But all in all, so far the data has been sort of in line with these initial expectations. No revisions or no significant revisions are expected. Unemployment rate is expected to stay at 5.9%. Participation rate expected to remain unchanged. The average hourly earnings also to continue rising at 0.2% or 2% year on year. All in all, expectations are to have more of the same. So, if we have job gains of above 250,000, I think it'll be positive for the US dollar no matter what. If we have under 200,000, it'll be negative for the US dollar no matter what. But there's, of course, a better chance that it'll be somewhere in between. And that means that the response in the markets will probably depend, in my opinion, on other factors, which are, first of all, participation rate. First of all, it needs to go up to pick up the slack. It means more people participating in having jobs and making money, contributing to the economy, spending that money. It fell to levels last seen in 1978. Some of it is demographic changes, a retirement of baby boomers and things like that, but some of it is just discouraged workers and just stop looking for a job. So 63.2% is the level we've seen a few months ago, and that would be encouraging. The bottom is 62.7. If it drops even below this, it'll be discouraging and dollar negative. If it rises, of course, dollar positive. The unemployment rate is a bit less important after the elections because we want to see total number of jobs or not. When we have falling unemployment rate with falling participation rate, it doesn't mean that much. And the second factor is wage inflation. It's subdued or stable, steady, boring at 2%. Last month we had a month-on-month change of 0, no change. This time 0.2% is expected. As aforementioned, wages rise slowly, only when changing jobs or around the end of the year. I don't think we'll see a big change. So again, if non-farm payrolls are above 250,000, it's dollar positive. Under 200,000, negative. And in between, it depends if both factors go in the same direction. So if the participation rate rises and the average hourly earnings rise as well, it's dollar positive. If both of them fall, it's dollar negative. And if one goes in one direction and the other in the other direction, it's going to be a bit mixed and confusing. But all in all, we're in a dollar bullish world. So a huge disappointment in the non-farm payrolls is needed for a real change in direction for the US dollar. Of course, it's never a one-way street. We've seen quite a few dollar corrections along this rally. But we really need a disaster in order for a material change in the positive direction of the US dollar. That's it. Now it's time for questions. What do you think will be the next direction of euro dollar? Any questions about what I showed, or about you want to talk about any other currency? I'm here. Let's see. Okay, well, I await the questions in the chat. There's also... Okay, while I wait your questions, take this opportunity to thank FX Street for hosting the webinar. Thanks as always. You're welcome to visit forexcrunch.com. Specifically, we recently launched the Market Movers podcast. I'm doing it with Leo Coin of Trading Energy. I think it's a fun listen. And here are my contact details for if you have questions or anything else later on. And I'll mention also the mobile, Android, and iOS apps, the iPad app as well. Any questions? Let's get back to the chart in the meantime. Oh, there's a question. What do you expect from euro dollar? Well, in general, I expect euro dollar to continue falling, especially due to the ECB. I think that Draghi is determined to fulfill the mandate of getting inflation at 2% or a bit below. So I think that he will drop a significant, show his determination, his commitment to print as many euros as possible, not using these words, but he'll show his commitment to do everything it takes, enlarge the ECB's balance sheet, print more euros if you wish, to push inflation higher, to fulfill the mandate. And he needs a lower value of euro dollar. For the United States, it's not that significant to have a weaker dollar, to have a stronger dollar. Sorry. So I think the trend will continue, and we'll see more falls for euro dollar. And specifically this week, I believe that Draghi will hit it hard, and non-farm payrolls will probably not be in the way. Just a second, let's see. Euro dollar 125 is the key level, and I think it's a level eyed by many. It's also 80 cents if you look at dollar or euro. And when we first tackled this level, we had a big bounce. That's where the big dollar correction began. So for me, it's more like a pivotal point. The pair is basically battling this line. I don't see it as a line of support or resistance anymore. It was huge support. It worked well for quite some time, and then didn't. Gold and oil. Gold is certainly not glittering. The main reason is no more QE in the United States, no more dollar printing that went to bonds and then to commodities such as gold. Also, I think that there was a huge hype a few years ago, 2-3 years ago, about gold as a hedge against inflation. We talk about it in the podcast, in one of the recent podcasts. It doesn't work as a hedge against inflation, and especially as inflation is low all over the world, not only in the Eurozone, but also in the United States. It's not that high. In the UK, it's 1.2. We've seen CPI falling in other countries. So I think many just went away from gold. Gold does have a value in industry and as in jewelry, of course, and there is always support for a gold price. But as a hedge against inflation, as speculation, as a doomsday scenario, it didn't work out, and I think people are moving on. So. Strong economy, weak gold. There is a correlation, yeah, because when you have a strong economy, you have rising interest rates, and then it's better to put your money in deposits in banks because you get interest rate. And it's not that good to invest the money in gold or in stocks or in anything else. So, yeah. In recent years, we had low yields everywhere, nothing to invest in. I mean, of course, some stocks did really well, but gold was seen as a safer thing. But gold has no yield, and gold can fall. And about oil, I think someone asked about oil. Let's see. Well, I'll talk about it anyway. Prices of oil have been falling dramatically. Oil is hit by both sides. Also, we talk about this as well more in depth in one of the podcasts. You can see the titles of the podcasts and check it out. But basically, Saudi Arabia, especially in other countries as well, are producing a lot of oil, and there's too much supply. Also in the United States, shale oil production capacity is increasing all the time, and we have lots of supply. And on the other hand, demand is falling because China is slowing down, the Eurozone is slowing down. So these are the reasons for the fall in demand. So we have less demand, more supply, and the result is falling oil prices. Specifically this week, the Saudis said that they're cutting oil prices for their exports to the United States. So there's some kind of price war with their friends or not so friends in OPEC. Also, the Russians are stuck with too much oil, I think. Anyway, it's at some point it's going to reach a level where it's not going to be worth investing in new oil projects, or when the picture is going to turn around. But so far, there's been a fall of 25% from the highs of above $100 per oil barrel in WTI. Japan is buying. Oh yeah, that was a big move. We focused here on euro dollar and the ECB and NFP, but last week's huge surprise was the Bank of Japan. In short, in Japan, they want to fight deflation. They want to have also 2% inflation. And they did a lot. Fiscal stimulus, monetary stimulus, printing more yens. And also, the Prime Minister wanted to do some reforms. All this began in late 2012, had a huge negative impact on the yen. But what happened recently, the Japanese government raised the sales tax from 5 to 8% in April. So it did lift inflation, but artificially. So the Bank of Japan looks through this. Anyway, it hit the economy because people were buying less, and reforms weren't coming through. So we had two moves last week. We had also, first of all, the Bank of Japan enlarging its target for its balance sheet from 60-70 trillion yen to 80 trillion yen. And that's a lot for a country like Japan. I mean, the size of the economy, which is smaller than the United States. It's the world's third largest economy. And we had the Japanese pension fund, which is also a huge institution, deciding to buy more foreign stocks and more foreign bonds. And of course, if they send their money out of Japan, it's negative for the Japanese yen. But the move has been really sharp. I don't know. We're not at 115 yet, but we're quite close. I think it'll stabilize at some point, but in the meantime, we had also huge moves on crosses, like the pound yen, or yeah, pound yen was the extraordinary move, 500 pips in one day. China buying gold. Yeah, there is the natural demand for gold for jewelry and all this Indian weddings, and of course there's basic demand for gold. That's why will never be fully eroded, but the speculation money went away from gold. Tomorrow, pasta feast. Yeah, pasta is good before a marathon run. I think Draghi is running a marathon on inflation. He's not going to quit. Uh, I I think he has to do more to fulfill his mandate about inflation, and more pressure will be a feast for markets and a feast for Europe, which will have a competitive edge on in exports, specifically here in Spain. I think olive oil, wine coming from here is just great, and perhaps if there would be a weaker euro, there would be more demand outside the eurozone for these great products. Uh, Even if we don't have a pasta party tomorrow, in terms of some very dovish comment from Draghi, we'll have a very interesting press conference because of all the recent gossip or news. Well, it's a mix, I guess. Okay, I think it's about time to wrap up. Any last question or? Anyway, thank you very much, FX Street. Thank you very much, everybody, for coming. I'm very happy to see higher market volatility. I hope it will continue. When there's higher volatility, it's important to use lower leverage, so trade safely. And I hope to see you next time. Yeah, thanks. Is this recorded? Yeah. Yeah. Great. So for those who missed some parts, had technical issues, or want to revisit what we talked about here, you can always see the recording and see other great webinars on the FX Street website. So that's it. Thank you very much, and hope to see you soon. Bye-bye.